So once again, we're going to be continuing with Chapter 11. Does anybody have any questions to start us off today based on what we went over on Tuesday? Uh, Again, we went over the characteristics of a bond and the journal entries for recording the initial issuance of the bond, amortization of it over a period of time, and then calling a bond and also paying it back at the maturity date. And now we're going to go over briefly some financial reporting topics related to bonds. And they're reported as liabilities on the balance sheet, and any portion of the bond that's due within 1 year is reported as a current liability, and any remaining bonds are reported as a long-term liability. And the carrying value of the bond is the amount that's reported on the balance sheet. And so remember, when we issue a bond at a premium or a discount, that means that more or less cash was received when we issued the bond because there's a difference between the coupon rate and the market rate of interest at the time of the issuance of the bond. And so the amount of cash that we receive, that's what the liability is worth at the time that it's issued. And then as we amortize the premium or discount, the carrying value changes and slowly approaches the face value of the bond over the life of the bond, as we saw in the graph towards the beginning of this chapter right here. The liability on our balance sheet matches the carrying value of the bond. And if the bond is issued at a discount, carrying value slowly increases to the face value, slowly decreases to the face value as it approaches the maturity date. And that is the true liability that is owed by the company. So that's what's going to be on the balance sheet. Also, the payments of the bond, the coupon payments, are not going to show up as a current liability because they're interest that's paid as it goes. And so that interest hasn't been accrued yet. Only the principal portions are shown on current liabilities. And any unamortized premium then is a premium increases the amount of cash we received and it increases the carrying value. And so that adds to the value that's reported on the balance sheet, and a discount reduces the amount of the carrying value, reduces the liability on the balance sheet. And a description of the bonds should be reported on the face of the financial statement or in the accompanying notes. And it's almost always done in the accompanying notes because companies have a whole bunch of different bonds that they've issued over the years and with different maturity dates. And that's going to be shown in the long-term debt footnote. And it's going to list out all the years in the future when they have maturities coming due. It's really important for creditors to know, because when a bond comes due, the company either is going to need to have a lot of cash from operations to pay back the bond, or they're going to need to refinance it into new bonds and new bond issuances. And so that capital requirements, knowing when the bonds are due, because unlike installment notes are paid as they go. Think like a mortgage or a car loan. Those are paid back every month. Bonds are interest-only payments, and then the lump sum is due at the end of the bond. And so it's really important for companies to disclose in the financial statements what's going to be due at the end. And so this is how it looks on the balance sheet, right? We have our current liabilities, including any bonds that are due where the maturity date is within the next 12 months. That would be in the current liabilities, and this under short-term debt obligations. Long-term debt obligations is where the majority of the bonds would be because they're due within more than 1 year. And in the footnotes, the company is going to disclose all the maturity dates of their debt obligations, including, so due in 2022 is 3.8 billion. Again, this is for Pepsi's recent 10K for the year ended December 2025. For the year ended December 25th. I actually don't know what year this is from, but this must be from 2021 because they're disclosing debt due in 2022, right? So 3.8 billion is due within 2022, and now the banks know when they're considering whether or not to buy more Pepsi bonds or issue Pepsi more loans, they know the cash flow needs for financing that they're going to need to pay these loans back over the next 40 years. Essentially, they have debt that's due in 2020 and 2060. Then they also have some installment notes due over time, 2021 through 2027. And then they also, the current maturity of long-term debt obligation is 3.8 billion, and that's the exact same as the 3.8 billion up here. So due in 2022, that's the next 12 months. And so that all matches to each other. And the issuance of bonds is really important because it's how companies fund their long-term operations without going to shareholders to raise more money equity-wise. There's two ways companies can raise money. It's debt and equity. And debt allows companies to leverage their growth and expansion while not requiring additional capital from stockholders. And then if the company can make more money than the interest that they're charging, then leverage amplifies returns of the business up or down. So if a company borrows a whole bunch of money with bonds and then makes a lot more money, the percentage return for the equity shareholders is much more. But if they lose money, then the percentage loss is much more. And so that's why it's such a valuable thing for a company to do. It's high risk, high reward. And there's a couple things about bonds. They're usually purchased for growth and expansion, purchase of fixed assets or other strategic needs, things that need a lot of money to expand the business and generate additional returns. And so they are considered a liability and not an asset. Despite providing a large cash infusion, they're considered a liability because when we think about the accounting equation and assets and liabilities, we're receiving cash, and then we also have this payable that's going to be paid in the future. And so our assets are going up and our liabilities are going up. And so it's not considered an asset because it has to be paid back. And bonds would only be considered an asset on the company's balance sheet if it's the company that owns the bond. The bank or the investment firm that owns the bond would be an asset to that company and a liability to the debtor company that owes the bond. Again, once again, the bonds are a liability because there's something that's owed. And there's a couple financial reporting issues in this example here in this long-term debt footnote. And it says, in the beginning of the current year, 2 bond issues, Simmons Industries for 7%, 20-year bonds, and Hunter Company for 8%, 10-year bonds were outstanding. During the year, Simmons Industry bonds were received at a significant loss on the redemption of the bond, and it was recorded on the income statement portion of the balance sheet under operating income. And the Hunter bonds were recorded as a non-current liability, and the maturity date of the bonds was early in the following year. So there are 2 major issues with this is that if you remember from our examples on Tuesday, when a company calls a bond, the bond may be worth more or less than the actual remaining amount due on the bond, depending on the conditions and whether it was rate at a premium or a discount. The difference between the cash paid to redeem the bond and the carrying value at the bond results in some sort of gain or loss when a bond is called. And that gain or loss has to be reported in other income or other loss that not in operating income, because that's not part of the operations of the business. If Pepsi is making or losing money based on the calling of their bonds, that's completely unrelated to selling Pepsi. And so that needs to be reported as other income or loss because that's a decision sort of the finance portion of the business. We should not be judging our operating management of the business based on the decisions the finance team is making on whether or not to call these bonds or not. Also, the current versus non-current liabilities, the maturity date of the bond was early in the following year, and so it needs to be recorded as a current liability because it's within the next 12 months. And now we're going to be talking about the times interest earned ratio. And essentially we have, this is a way to assess the debt load on a company and how effectively they're able to make their interest payments. And it's used by banks to determine whether or not a company has sufficient cushion for them to lend them more money, essentially. And also by investors to see how much of the profits of the business are going to interest and debt and not to equity and dividends. Because it's really important to know if a company is if the operations of Pepsi are super high, at high profit, and they're making a bunch of money every year, but it's all going to support a super high level of interest for a lot of debt, then there's going to be nothing left for the equity holders. And so this really just, what we take is income before income tax expense plus interest expense divided by interest expense. And that shows us how many times the interest was earned. When we do the income before income tax expense, because interest is tax deductible for corporations, and we add back the interest expense because we want to calculate the profit before interest and taxes divided by the interest expense to know how many times the company has earned the interest, because the operating income of the business would be before interest and taxes. And so high values of the ratio are generally considered favorable because that means they have more profit and less interest. And so a times interest earned ratio below 1 would mean that the company is unable to cover their interest expense throughout the year and would be also operating at a net loss. So if their income before income tax is plus their interest expense is less than their interest, that means that their interest is higher than the pre-interest earnings of the business. And they're definitely going to be at a net loss on the bottom line. And then companies can also be losing money as well before interest and taxes, even like there's no requirement for companies to have a profit. And so then the times interest earned ratio would be negative, and then it's really hard to judge. Can this company cover its interest payments? Because the bank would essentially be betting on the future earnings of the business and the strength of the collateral that's backing the bonds. And such a situation, and those situations could eventually lead to loan defaults. And the primary consideration of bondholders is preservation of capital. What is the collateral? What are the future cash flows of the business? And how can they provide the future cash flows of the bond? And so, once again, as we've looked at in all the previous chapters, it's super important to compare companies in the same industry when looking at all these ratios, because we can't compare a tobacco company, a railroad company, a tech company and a beverage company and expect them all to have the same leverage ratios because the industries have significantly different risks, operating expenses, and capital requirements that all need different debt loads, different profitability metrics, and different amounts of capital required to even start the business. And so in this example here, we have income before income tax expense for Pepsi. And to calculate, what we need to do is add the interest expense plus the income before income tax expense, and we get 11,684, and then we divide that by the interest expense, and we get a 6.3 ratio. And as we can see here, Pepsi has the lowest times interest earned ratio. That means they have the highest debt load of all these three companies compared to the amount of profit that they have. And so Keurig, Dr. Pepper has a ratio of 6.6, and Coca-Cola has the highest times interest earned ratio. That means they have the lowest debt load. And that means that banks will probably allow them the lowest market interest rate when issuing new bonds. And for example, Coca-Cola has less total interest than PepsiCo and more total income. And so you guys can see how that relationship works. And now, finally, we are going to get into one of my favorite topics of all time, which is the present value of money. And this is really what allows investments to work, and the whole concept of banking and interest to work. And what it really is that a dollar today is worth more than a dollar tomorrow. And borrowing money is essentially purchasing money today at the expense of more money tomorrow. And if we invest today, we are going to get a return on our money and more dollars tomorrow. And that that depends on the interest rate depends on a lot of factors, including the risk-free interest rate, inflation expectations, credit expectations of the company. That's what determines the market rate of interest. And then the present value of bonds that we're going to calculate depends on a number of things, like the face amount of the bonds, which is the amount due at the maturity date, also the coupon payments that are going to be paid on the bonds. And then an investor determines how much to pay for the bonds by computing the present value of the face value of the bond at the end, and then the present value of all the payments, all the coupon payments throughout the period of the bond. And the present value is the value of an asset or cash at the present. And then the future value is the value that's in the future. And so we have all these formulas that use compound interest exponential formulas to calculate the present value today, given the value of the future sum and the discount rate and the number of years or periods. And then also, if we're calculating how much is an investment going to be worth in the future, we can calculate the future value based on the present value. And I think that a lot of times, if you've ever looked up a savings rate calculator or an investment return calculator, and a dollar invested at 20 years old is going to be worth $60 at retirement at 65 at around an 8 or 9% interest. That would be calculating the future value from the present value. But when we're looking at bond valuations, what we need to do is calculate the present value from the future value, because we know that at the end of the bonds are generally issued in $1,000 increments. We need to calculate what the present value of that $1,000 is and the present value of all the 5% coupon payments that are made for the next 5 to 10 years. And so in the formula here, the at a 10% interest rate, $1,000 today is worth 1,100 in a year. That's generally and then a future value of 1,100 is worth $1,000 today. And so the trade-off goes, yeah. So it's the future value of, and then 1 plus the discount rate. So in this example, it would be $1,000, no, 1,100 divided by 1 plus 0.1 is because 10% is the discount rate it's only 1 year, so to the first power. And so 1,100 divided by 1.1 is 1,000.
You're doing the power?
Yes,
So
yes.
10 years.
Yep. And also, because most bonds have semi-annual interest payments, and this is really, we'll go into this when we look at the tables too, because most of the time we're not going to actually be writing out the whole formula as itself, but I have this on every slide just to sort of imprint like this is what the tables are giving us for the calculations, because
on the slideshow we're given, it doesn't actually have.
yeah, I added that this morning. Yeah. But I'll post these. I'll post this slideshow as well. And also I always post the lectures online too, so you'll have this. But for most bonds too, they're semi-annual interest. And that means that the interest rate is compounding twice a year. And so what we do in the formula is we divide the discount rate by 2. So in this case, if this was a semi-annual compounding, what we would do is the discount rate would be 5% and the amount of periods would be double. So 2 periods. And so we basically use the same formula and we compute the interest every 6 months instead of every year. So we have to double the periods and half the interest. And so in this case, the interest would be 5% and it would be 2 periods. And we can calculate back to the future value at the interest. If the future value is 1,000, 1,000 divided by 1.1 is $909.09. And so we could also say, okay, we know that we have this future expense. That's $1,000. How much do I need to invest today at a guaranteed rate of 10% to grow it to $1,000 by the time that I need this cash? And so that would be I guess the way to think about that. And then if we're receiving an amount in 2 years, then the exponent goes up by 1. And so if we have the future value divided by 1 plus 0.1, so 1.1 to the second power, and that is 1.21. And so if we take $1,000 divided by 1.21, we get $826 is the value today of a future value in 2 years of $1,000. And so that's how we calculate the present value of $1 or $1,000 that's going to be received in 2 years. And we have this table that shows us the factors calculated for the present value of a single dollar. And so if we're calculating the present value of $1,000, we would multiply the factor given by 1,000. And so in this case, if we took the present value of 10% and 2 periods, we get 0.82645. And that's times 1,000 is equal to $826.45. And so you can access these tables in the homework by clicking on the blue links in the problem. And I also show that on my explanation video. You'll be able to access these tables that way by clicking on the link, and then it'll bring it there. And then, does anyone have any questions about using these tables? Because I know that they can be, they can be unintuitive, and we'll go through examples. So don't worry, but okay. So now we're going to, since there's two, this would be how we calculate the present value of a single amount received at a future date, which would be like the face value of the bond. However, we also get a coupon payment every 6 months on all these bonds. And so what we need to do is calculate the present value of an annuity, and we value them separately. We value the face amount and then the coupon payments separately and add them together at the end to calculate the total market value of the bond currently. And so a series of equal cash receipts spaced out over a period of time is an annuity. And you can think of an annuity as like they're often offered in retirement. I'm going to buy a fixed income annuity and it's going to give me a certain amount of money until the rest of my life. And that's generally what's marketed as an annuity. But the simple definition of annuity is a series of equal cash receipts spaced equally in time. So a monthly payment, a semi-annually payment, an annual payment, that will be considered an annuity. And we can calculate the present value of an annuity by taking the present value of each individual payment and discounting it back to the present. And so we could calculate the present value of an annuity for 10 years by taking each single payment and discounting it by how many years that, or how many periods that payment is in the future and adding it all up. But we also have a table that has added it all up for us. And for example, if we're getting, this bond was a $1,000 bond that was issued at 10% interest. It's the same one that we looked at in the previous slide. And so that means that every year, and this one only pays the coupon annually to make it simpler for this example. And it pays $100 at the end of each year. And so we have to discount the $100 at the end of year one using the year one present value of a dollar factor. And so we take 100 times 0.909 and we get $90.91. That's the present value of the year one payment. Present value of the year two payment is $82.64. And so both payments is $73.55. And the formula for that is to take the payment multiplied by 1 minus, again, 1 plus R to the number of periods divided by R. That's only for your reference. You're not actually going to be expected to actually use the formula to calculate the present value of an annuity, but I wanted to include it for all you math nerds out there. And I also do think it helps conceptualize what is behind these formulas here. And so the present value of an annuity at $1 compounded interest. Note how the first row for a single period, the present value of $1 and the present value of a $1 annuity are exactly the same for each interest rate because it's the same as computing the present value of $1. But for period 2, we need to calculate the present value of $1 for year 1 and year two and add them together. And then we take this factor and we multiply it by the payment amount. And so for a bond, we calculate the payment amount by taking the face value, multiply by the coupon rate, and then we get the annual or the semi-annual payment, and we multiply by the proper factor. And so now we're going to go over. And does anyone have questions about how to use this before we get into an example of pricing a bond with these factors? Perfect. So the selling price of a bond is the present values of the face amount of the bond that's going to be due at the maturity date. So that's the present value of a single sum, because we know that 5 years from now, the owner of the bond is going to get $100,000. And then the present value of the periodic rate of interest, which is the contract rate or the coupon rate, at 12%. And so every 6 months, they're going to be paid interest semi-annually on June 30th and December 31st. The 12% is an annual interest rate. So every 6 months, they're going to get 6% interest on the bonds. 6% of $1,000 is $6,000. So every 6 months, they're going to get $6,000. That's 10 periods, and then at 6% interest. And so because the bond is paid semi-annually, we have to assume the compounding of the interest is done semi-annually. And how we do that is we multiply the number of periods by 2 and then divide the interest rate in half, because we're computing the formulas based on every 6 months. And so we take 10 periods at 6%, and we find our factor. 10 periods at 6% is 0.55839. And then if we take 0.558 times $100,000, we get $55,839 as the value for the single sum of the face amount. That's the present value of the $100,000 payment at the end of the 5 years. And then to calculate the present value of the annuity, we need to take 100,000 multiplied by 6%, because the coupon rate is 12%. But the interest is paid every 6 months. So we need to divide that amount by 2. And so we get $6,000 paid every 6 months. And we have to find the present value of 10 periods of the annuity at 6%. And that's 7.36009. And we get 44,160 as our present value of the annuity payments. And because the contracted rate of interest is the same amount as the market rate of interest, the total present value of the bonds is equal to the face value. Assuming that the market rate of interest was 11%, if the market rate of interest was 13%, then the bonds would have to sell at a discount to make up for that, because we would be taking the $100,000 times the 13% factor. And so if we took $100,000 multiplied by 6.5%, because the 6.5% factor, because 13 divided by 2 is 6.5%. 6.5% for 12 years is 0.53273, which is less than 0.55839. And again, in the formula for computing the present value, the discount rate is going up, which means that the denominator is increasing, the numerator stays the same, and so the factor is going to go down, and the value is going to go down if it's discounted at a higher rate of interest. And so if the bond is selling at a if the market rate of interest is 13%, then the present value of the bonds decreases and it's going to sell at a discount. And we're going to have our journal entry where we record the cash received of $96,000 and then another debit to discount of $3,600 and then a credit to bonds payable for the $100,000. And if the bond sells at a premium, then if the market rate of interest is less than 12%, which is the contract rate of interest, then the bond is going to sell at a premium because because we're discounting it at a lower rate, and so it's going to be worth more today. And so then we would have to record again our debit to cash for the cash received of $103,000, and then we'd record the premium as a credit for $3,769, and then the bonds payable the face amount of $100,000. And the present values can be computed directly or using a financial calculator or a spreadsheet. These formulas are all in Excel. Using the PV or FV formulas in Excel, you can calculate all of these, and you can also calculate both parts in a single amount. It has an input in Excel for the ending value, as well as the value of all the payments throughout the period, and then the discount rate, and then it gives you a present value based on that. And this is the same exact formula as before for the present value of the dollar. We have the present value of the dollar as the numerator, and we have the ending value as the numerator. The denominator is 1 plus the interest rate to the power of the number of periods. And so Ashley wants to attend graduate school in 5 years and would like to have $5,000 in her savings account at that time. So what is a one-time deposit amount that she needs to make sure that she has enough money to meet her goal? And this is at 10% interest rate. And then refer to the present value of a dollar table. And I have the present value of a dollar table here. So we have $5,000 as the goal, the future value, and we need to discount that back to the present at a 10% rate of interest. And we have a 5-year period. So we have to find our 10% factor for 5 years, which is going to be 0.62 So we're going to take our future value of $5,000 multiplied by 0.62092 and get $3,104. And Um, yeah, that's how to use the present value factor tables. And it's also just really cool to note that this is how we can plan savings in our own personal lives. If we know that for retirement, uh, we need to have a certain amount of more money saved up, we can discount that and we use a number of periods more than 10 years for sure. How much money do we need to save? But if we knew that we wanted to have $1 million 10 years from now at 10% interest, we'd only need to have $385,000 today because we take $1 million times 0.385 and we get the value of that money today and the value that it's mathematically going to grow to over a period of time. And we can also calculate the present value of the amounts that are due. And so assuming that we're going to receive $10,000 in 10 years, and the market rate of interest is 4%, what is the present value of this amount compounded annually? And why is it less than $50,000? So we're going to take the 10-year rate at 4%. And so we're going to need to multiply $50,000 times 0.67. And the present value would be 33,778. And why is this less than the future value? Does anybody have any thoughts as to why 37,000 or 33,000 today is worth less than 50,000? Yeah, it's just the present value of money. $1 today is worth more than $1 tomorrow, right? We know that we're gonna make this amount of interest. We know that this $33,000 today can be invested at 10% for 10 years, and then we can make that amount of money in the future. And this is also just an interesting problem for annuities. I don't know if you guys ever heard the commercials. People trying to buy out annuities. It's my money and I want it now. So call 1-800 my money now. You know, and they'll buy out annuities that people have invested in, and they will then get the cash flows instead of you, and they will use the present value of an annuity formula and table to calculate how much money are they going to give you for the annuity. And of course, they're just going to drop the interest rate a few percent so that they can make their money. But if you truly need the money now, it'd be a way out of financial situations, I guess. But generally, you know, they're making money off of doing this because they're providing a less of a discount rate. And this brings us to the effective interest rate method for bond amortization. So on Tuesday, we covered the straight line rate method of amortizing bonds, and both of these methods will be on the homework. I've recorded videos for both. I just haven't posted them yet for going over the homework. But essentially, under the straight line method, the interest expense every single period was the same. We simply, to amortize the bond, we took the discount or the premium, divided it by the amount of periods, and every 6 months, that was the amount of discount or premium that was amortized. And then the interest expense remained the same every single period. That's not a GAAP method because the carrying value of the debt is what shows up on a company's balance sheet. And the market rate of interest that a company's that a company was charged on a particular loan, that's the amount of interest that they should be showing on their balance sheet, and that's not a linear amount. And so the proper way to calculate the interest expense every period for a bond is to multiply the carrying value of the bond by the market rate of interest at the issuance of the bond. And the carrying value increases or decreases every single time we're amortizing the discount or the premium. And for this example, we have 12% 5-year bond issued at a discount because the market rate of interest at issuance was 13%. And the amortization is going to go as follows every 6 months for the entire life of the bond. The 6% the 12% coupon paid every 6 months is 6% or $6,000. So every 6 months, the amount paid is $6,000, and the discount, the unamortized discount is going to be the value in our T account at the on that particular date. So the date of issuance is January 1st, year one. And so on January 1st, year one, the amount of unamortized discount is the initial amount of the discount, which is the $100,000 minus the $100,000 face amount minus the $3,594 in interest. That's the cash that was received for the bond. And then when we're calculating this journal entry, under straight line amortization, we calculate the discount amortization first because we divide the discount and we do equal amortization over all the periods. In this method, we calculate the interest first and the discount amortization is plugged. And so we multiply the carrying value of 96,406 multiplied by 6.5%, which is the market rate of interest every 6 months for this bond. And we get a total interest expense of $6,266. And then because the cash paid was $6,000, the discount amortization is $266. And the new carrying value is so then we take 3,594 minus 266 is the new unamortized discount. And then we get a new carrying value. And for bonds issued at a discount, their carrying value will slowly rise to the face amount over the life of the bond. For bonds issued at a premium, this carrying value will slowly decrease to the face value over the life of the bond. And so that means that for bonds issued at a discount, the interest expense slowly increases every period because the carrying value increases, and the interest expense is computed based on the carrying value at the beginning of the period, every single 6-month period. Do you have a question or? So the unamortized discount slowly decreases to 0. To $100,000. And if we recall the journal entry to create a bond issued at a discount, we debit cash for the $96,000, credit the discount. We debit the cash, we debit the discount of about $3,500, and then we credit the cash for $100,000. And then because when we created the discount, it was a debit, so to reduce the discount, it's a credit. And so we calculated our interest expense at $6,266, and we know every 6 months we owe $6,000 in cash, and so that's going to be a credit. And then the difference between our debits and credits is $266, and so that's the amount that we have to reduce the